Well, hello, good morning, everybody. Thank you, Zanny. Thank you for being here in person. Like Zanny, I'm absolutely thrilled to be here at a physical event for the first time in absolutely ages. So that feels great. I'd like to invite my panelists, please, to join me, if you would. And we'll, in the interests of time, go straight into it.
Where are you sitting, sir?
Yes, anywhere. That's fine. So
Sandwich in the middle.
you heard it there from Alok Sharma. None of this is going to be possible without finance. This session is going to be focusing on London as a centre for green finance. So how to make sure that London plays, or London will play, I'm sure, a very important role in this, but how to make sure it really plays lives up to its potential and is perhaps the centre for green finance. So to answer that and to address the issues, I'm joined by Rhian-Mari Thomas, Chief Executive of Green Finance Institute, Joanna Cound, Managing Director and Co-Head of Global Policy Group at BlackRock, and Richard Hammell, Managing Partner of UK Financial Services at Deloitte. So, Richard, if I could get you to kick us off with a sort of overview, that's the sort of exam question, how to make sure that London is the preeminent green finance centre.
Great, thank you. It's a privilege to be here, Daniel, and also to be on the panel with Joanna and Rhian-Mari. I actually might change the phraseology just a little. I think we should be about the UK being the global hub for climate finance. And while London is absolutely critical to that, there are other centres across the UK that I think we need to bring together into it in order to pick up on Alok Sharma's points about turning the commitments and the pledges of the 130 trillion into reality in the next few years. I think we need to take a systemic approach, and the feedback I get from lots of institutions and clients is that there's a really important systemic approach for us to take in the UK, which is to establish the UK as the leading global financial centre for climate finance and green. And that involves us accelerating the transition for the UK to be the leading net zero growth economy and supportive of all aspects of our economy. And secondly, recognizing that we have a critical role to play in financing green across the world. And we need to understand, as Alok Sharma referred to, that if we take the 1.5 degree estimates from the Paris alignment and look at a number of studies of scenarios, in order to meet that, we will require 100 to 150 trillion dollars worth of investment over the next 30 years. More than half of that will be required in the emerging markets. So how do we create this global hub? Well, there are 5 components that clients feed back and institutions, again, to a systemic approach. The first is we have to be, in the UK, the centre for innovation and green finance itself. We have to be the place where all of us can come together and create those technologies that we can scale the technologies that enable the transition and the move to net zero. Some of those technologies, I think 50% of the emissions that we need to address come from technologies that are not yet even commercially available. The second is we need to move from looking at things in a binary fashion in terms of green and brown to thinking about transition. There are many companies, especially those small and medium-sized enterprises, that need help with transition finance. We need toolkits, taxonomies, product decarbonization trajectories that enable us to look at how we move from our existing businesses towards green and not only look at it in a binary fashion. We, and I think the UK is uniquely placed to do this, we have the ability to create a holistic and integrated approach to financing. Asset owners, asset managers, banks, insurers, non-bank finance and other organizations coming together to create the environment, the financing, using the London market for insurance, for underwriting and risk management, to be able to create an environment where we can lead in enabling that whole economy. We need an inclusive financial system. We are going to find that this transition affects different parts of our economy and different parts of our country in different ways. And while many jobs will be created as a result of all of this innovation, it won't necessarily, without our intervention and our help, be created in the same socio-economic groups or parts of the country as the jobs that will be lost associated with the transition. And the final one, which is normally the first one, but I thought I'd put it last just as importantly, we need clear and practical regulatory environment. And that is one that does three things. It enables clarity in taxonomies, in data, as we have the disclosures and delivering on those, and it requires innovation. So the FCA second fintech tool, sandbox being an example. And the final one, we in the UK, and particularly out of London, we need to push for global consistency and harmonization in those standards in order for us to be successful.
Well, that's quite an agenda. So, small task. But just a broad follow-up question on that. I mean, you're dealing with a lot of clients across the board. Do you sense this sort of change that that Alok Sharma was talking about in the way that businesses are stepping up, in the way that people are approaching you for engagement, and is there a sort of level change going on? Where are we in the sort of stages of where we need to be in terms of engagement across the board?
Yeah, so I think I guess I put it into three areas. So one is commitment, seriousness amongst boards and executives. I think we're way down that line, certainly of the larger businesses, and I'll come back to other.
Way down compared with where we were. I mean,
I think the build up to COP26, the commitments many of those organisations made in pledging at COP26, and the activities that they've taken since have moved us forward considerably. Yes.
Yeah.
I imagine fellow panelists will further emphasise that. So I think that is true. I think in many institutions they're grappling with how do they gather the data to be able to substantiate the disclosures that have to be made, the risk management and the portfolio analysis that needs to be done. So I think one of the biggest challenges in honouring those commitments is getting the accuracy and reliability of data to be able to evidence that progress and that move. I think that's the second point. And then the third is I think we just need to be aware that I think the progress in large businesses is apparent, serious, and people are moving forward in a way that is consistent with commercial as well as green goals. But that smaller businesses have got a lot further to go in making that transition to green. And I think there is a risk as we move forward in thinking about all of the disclosures and all of the commitments of large businesses that we forget. For example, in the UK, 99% of businesses in the UK are small and medium-sized enterprises.
But these things are linked, of course. I mean, the measurement question, it's much harder for small businesses to be accurate. But when you have accepted methodologies and ease of access to those things, then it becomes easier for the small businesses. Yeah. Joanna, could I ask you to pick this up? You're in the business of actually managing people's money, so it's the hard end of it, as you like. And how central is it for London? Let's not lose sight of what we're talking about. London as a green finance centre. What's the challenge?
Okay, so I think the first thing to say is that for London to be a green finance centre, it has to retain its preeminent position as a global financial hub, full stop. So that's attracting global capital to UK businesses, businesses coming to raise capital here, but also vitally investors in the UK investing throughout the globe. So really the point that Alok Sharma made about the 1 trillion need for emerging markets, our clients want to invest in that, and I can come back to that later. So it's, I think from an asset management perspective, it's absolutely vital that the UK remains open to two-way flows. In terms of what we're seeing from our clients, I think the first thing, everything we do is as a fiduciary for our clients, and we are seeing really a tectonic shift in the thinking of the asset owner. Now, of course, there's a massive diversity, and different asset owners in different sectors think differently. But generally, their task for us is to try and help them navigate the move to decarbonisation. Some of them, most of them, need that. I mean, if we think of the scale of the transformation of the economies, the clients' portfolios reflect those economies, and the shape and the size of the transition is so uncertain, and that hugely tragic events in the Ukraine have just made that much more so. So the prime goal is to help navigate. The second, many clients actually want to drive the transition. We're seeing that. So that means that they might want to invest in green businesses, or they might deliberately seek out those firms that are very carbon heavy, but they're leading in decarbonisation, because that's where they see opportunity for them to add value to their portfolios while greening the economy. And then Richard mentioned also Invent. In fact, you started off with Invent. You see some clients really wanting to help invent the technologies of the future, invest in those technologies. So all three. And I've gone through all of that really because key to this, I think, is going to be the policy framework in trying to balance supply and demand. Most of policy has been on limiting hydrocarbons, but we need to balance that with demand to try and get some sort of balance between a orderly, or as orderly as possible, a transition, energy affordability and supply. But in doing that, we just need to be a green finance centre. We need to be cognizant of that huge diversity in terms of what the asset owners, their different approaches to climate investment strategies, but also all the different companies. I can come on to that later if you like, but as an asset manager, we're obviously stewards of our clients' capital. And so we're engaging day in, day out with the different companies as they think through how they manage that transition.
It strikes me listening to you that there's a tremendous challenge of communication around all this, because it's nothing if not complex. You're saying, it's not a question of just going to pure green. The transition matters enormously. In fact, if you're talking about impact, that may be where you can have most impact. But getting that across to potential investors, explaining it in clear terms, why it might be a good idea for you to hold in your portfolio elements that you might think was exactly the opposite of what green finance ought to be doing, but actually it's the most impactful. That's a fantastic communication challenge for you, isn't it?
Yes, but actually I think sometimes the challenge is more with other commentators and, dare I say it, the policy sector than necessarily clients, because there's often a tendency to the debate to revolve around what is green and what isn't green, and then to focus everything on green. Whereas, as you just said, the biggest challenge is how do you get through that? A lot of the asset owners, they innately understand that because their portfolios reflect today's economy and therefore are carbon heavy. So they're thinking, how do I get from here to where I've committed to get to? We heard all those commitments in 2050. So they are wrestling with that transition day in, day out. And I'd emphasize the point on data. I mean, obviously we're putting in masses of whatever resources needed to meet all of our commitments in terms of the financial services regulation, and there's it's relatively comprehensive. But our key focus, the core thing that we're determined to make sort of big strides on, is on data and on climate analytics. That's forward-looking, because that is the most important thing to help our clients understand exactly, to measure the risk in their portfolios now, and then to be able to navigate and track their progress in their portfolios going through the transition. So it's things like physical risk, implied temperature, exposure risk. So it's a big shift to be able to make that forward assessment of where companies are going.
Do you want to pick this up on the measurement side, on the sort of public policy side and the taxonomy side? How do you see the challenge?
Well, so many things I wanted to pick up, actually. It's the advantage of going last. Let's start with your point, Daniel. I think we're winning the challenge of communication. Mm-hmm. on this topic. I mean, if we look at Morningstar's latest data, we've got something like $2.7 trillion of assets, and which are now managed in almost 3,000 ESG funds. And in Q4 last year, there was over 140 billion of inflows into that sector. We can't be complacent. We need to continue to get the messages across about just how vitally important this sector is. And to pick up on a point Richard made, that it requires the entirety of the financial sector to be involved. And when I say that, I don't just mean the asset managers and the insurances and the banks. I also mean philanthropic capital, and I mean public sector capital. And very importantly, the mandate of the multilateral development banks and the development finance institutions, who have collectively balance sheets of over $11 trillion. And the reason I emphasize that point is because Alok was rightly very proud of the work that was done at COP26 to get 450 financial organizations signed up to GFANZ. That's 130 trillion of assets under management that they oversee. That's clearly not a war chest. That's not an equivalent of the 100 billion that can be deployed tomorrow. But it does mean that those are 450 boards that have recognized that this is an imperative and a priority for them strategically. But none of that money moves unless it can make money. I often get asked, why are we not seeing the money move more quickly, given that the political signaling is there and we've listened to the scientists, we know we have to do this. And it's very simple. The system is set up in order to currently maximize risk-adjusted returns. And if the returns aren't there, it doesn't matter how smart you are, you're going to struggle to invest finance in some of the solutions that we need to see in the real economy. And that is where we need this collaboration between public sector concessionary finance that can de-risk some of these solutions, so that we can actually start moving this mountain of GFANZ aligned money that needs to find a green home. Otherwise, all these organizations are on a pathway of shrinking to greenness in order to meet their commitments.
And what's the critical path to that? When you say public sector, sort of having the key to unlock this,
Yes.
who holds the key?
Well, I think for one thing, multilateral development banks and development finance institutions, the shareholders in those organizations they tend to be the G7 governments. Mm-hmm. So we have a huge lever to pull there. And the MDBs have pioneered financing in climate smart infrastructure, especially in the emerging markets, which is obviously so critical. And so they have a huge role to play in sharing that knowledge base, sharing things like their default risk rates, getting over that perception of risk that we've got for some of these emerging markets, which haven't been the chosen markets for large mainstream financial institutions. And then deploying their capital as genuine catalytic capital. So not so much financing the projects, but helping provide first loss capital or revenue guarantees, or a whole host of de-risking credit enhancement mechanisms that enable mainstream financial institutions who've all signed up to net zero to find ways of pivoting their risk-adjusted returns and their revenue models towards where we need it to go. One final point on that, if I may, Daniel. Between Paris and Glasgow, in that 5-year period, the top 60 global banks invested more than $3.8 trillion into fossil fuels. And I know we're talking about the nuance of some of that needs to go into transition, but bank lending is by far the largest source of fossil fuel expansion finance. Now, I'm not here to shame anyone. I'm here to say that's a lot of fees. That's a lot of P&L that we need to find a new and better 21st century way of replacing. And I genuinely think part of that solution, at least the catalytic solution we need to see at the moment, a lot of that is going to require collaboration with government balance sheet and with concessionary capital.
Joanna, you wanted, I sense you're itching to get in, so go ahead.
I wanted to amplify what Rhian was saying, particularly on the multinational bank side. We've been very vocal on the need to look at their mandates and reform that. I also thought it might be quite helpful to just set out how we try and think through the different pots of client money almost, because that links into the public-private debate. So the biggest pot is purely our clients' money, and they bear all the risk and reward for that money. So they decide what their strategies are, their investment strategies. And I would say, actually, there is, in Europe including UK, there's been a real change in terms of assessing both the opportunities and the risk. I think the change is the awareness that the transition offers a lot of opportunities as well. But with that pot, you can only go so far. So maybe we have a program called Decarbonisation, and that's sort of like an early stage equity fund looking at fostering, as it says, decarbonisation. But then the other two pots of money really rely on public-private partnerships. So the asset owners, they do want to invest in the emerging markets. But if you're trying to invest in like green technology or green transport in the emerging markets, that's a double up of risk. And they can't, some of them are reluctant to take on that risk. So that's where the first loss comes to. That then immediately, you think the biggest pot is risk, the pure client money. That then unlocks the amount of money that can go into emerging markets. And that was the program, Climate Finance Partners, that Alex Sharma referred to earlier. And then the final bit is philanthropic money, which can also have government money coming in. So the British government has invested in something called Breakthrough Energy Catalyst. And that's really investing, it's the invention part that you mentioned before in technologies that we have to scale up to be able to reach 2050, so like sustainable aviation fuel, green hydrogen, and other things. But for the last two pots of money, it's really public-private partnerships that are going to make a difference there.
So did you want to come in? I mean, there's so many pieces of this puzzle.
Yes.
And you partly want to, part of your job is fitting them all together, but how? Where do you start?
I would, well, yeah, okay. I was about to say I would love to be the person who fits all those pieces of the puzzle together. I probably wouldn't need to be on another panel again, but I love being on this one. So if I go to the invention, I do think a part of the reason that we're getting a lot of feedback about the importance of what we do in London systemically, bringing together all the aspects that Rhian-Mari and Joanna have talked about, is that the combo of willingness to take risk on behalf of financial institutions and the difficulty with the fact that there are a whole bunch of technologies that we need to invest in to create commercial scaling in order to be successful. We have to, London and the rest of the UK, and Scotland is definitely invested in this as well, has to be the place where the very best innovators want to come to create the next generation of green technology and climate safe businesses. Whatever that is about around electrical transportation, energy storage, we need the UK to be the place that the most innovative people want to come and list. They want to come and invent, and that will attract, as it has done in the past, it will attract the capital markets and the provision of private and public capital to those particular businesses. And we face enormous competition from other centres in Europe, other centres in Asia and in North America in particular, to be those centres. And I think one of the places I would start, therefore, is to look at all of the things we can do. And so we have seen some from the regulators and some from government to incentivize innovators to come here, to incentivize capital to come here, and to give whether it's tax related or other incentives for people to innovate and to invest in those critical technologies, the scaling of which will bring about the returns and reduce the risk for businesses. That's where I would start.
So sort of green industrial policy. We're a bit wary about that at The Economist, but anyway.
I was just going to say that Richard's point about innovation, it also applies directly to innovation in financial services itself. So, and the opportunity to pick up on your point, Joanna, to use the UK and the regulatory framework that we have here, the depth of the financial markets, our access to top world-class universities, etc., to actually use the UK as a lab for how we crack the code on some of the financial mechanisms that we need to actually make the money move before we start overlaying additional complexity, political risk, foreign exchange risk, etc., in some other jurisdictions where we know the capital has to flow. I think we have a huge opportunity here to do, and we already have a strong track record of doing that. And I, that's something I think that all of us can contribute to.
Jen, you wanted to come in there?
Well, I don't know how much time we've got for questions, but I support everything that's been said, but I think the policy also needs to think through. We've just seen with the Russian invasion of Ukraine, also energy affordability. So it's no good having the best innovators and the most wonderful policy if the transition ends up being not as just and not as fair as it might be. So I think we also need to bear in mind how do you think through energy affordability? How do you think through communities that might be more impacted? And how do you think through the incentives for corporations to move through the transition?
We do have a bit of time for questions. We have a roving mic, so who would anybody like to? Yes, you've got Slido questions there, have you?
Yes. So
excellent.
I have a question from Lorenzo. He's saying, how important do you think the AI is for better analysis of data and patterns to facilitate a green transition?
Want to take that?
I'm happy to talk generally about data because it was a point I wanted to make. I don't suppose I'm answering the question directly about AI, but I do worry that sometimes this fixation on data is paralyzing us to genuine action. When we look at what we actually need to do, which is deploying primary capital into the real economy, bank lending, IPOs, venture capital, private equity, real asset investment, this is the focus that we need. And I do sometimes worry that we expend so much of our precious ESG talent within our community worrying about secondary asset allocation and aligning to sometimes quite dubious metrics, as opposed to actually looking at what is working, replicating it and scaling it as quickly as possible. And my final point on this, which is one point I did slightly disagree with you, Richard, which is this point about the need for global consistency and standardization. I think we definitely need transparency around reporting and disclosure. But if we wait for standardizations, we're all going to be swimming to work. And rather than looking at ESG data as analogous to sort of credit ratings, why are we not looking at it analogous to equity research? Equity analysts frequently will have different target pricing and different recommendations, but we don't seem to be complaining about that. We recognize the nuance. Anyway, sorry, you can see you're leaping in here.
So,
I think the idea that we're all swimming to work is going to be the phrase of the morning.
I'm more optimistic, and I think that's a good note to end on the equity research side, because the data that we're trying to do, the forward-looking data, is much more akin to that. And it's been absolutely pivotal in us being able to say climate risk is investment risk, and then produce an analysis and reports to have discussions with our clients. So that is coming back to your point on the client education. And there was one other point that came up in that, and I've just forgotten entirely what it was.
Do we have more questions?
We do. So this is from Theodora. What is the role of local community lenders in channeling private investment into SMEs and communities at risk of being excluded?
Richard, do you want to go? You were talking about.
So I think it's a critical role. Whether on their own they have the financial clout to be able to provide all of that investment. So I think there is a combination of local and commercial and private. But I think one of the studies that we'll have seen recently from the IEA suggested that there'll be, by 2030 there'll be 14 million jobs created in the new green economy, sustainable economy, and 5 million jobs lost in fossil fuels. Now that sounds great because we've got a net increase in jobs, but one of the biggest challenges is that's not going to fall in an evenly distributed way. We're going to find that there will be communities that will lose jobs, and particularly in areas probably of the country that may already be suffering from relative inequality. So I think those roles are critical, both to make sure that we actually maximize both the invention of ideas and that it isn't only in certain locations, and secondly, to recognize that we have to take action in the transition to make it fair, as Joanna has said, which makes sure that local communities are not disadvantaged by our leaping towards, or swimming towards, or whatever, leaping towards a more sustainable future. And therefore, I think that local perspective is absolutely critical. I was in Scotland last week with talking to FinTech Scotland and the Scottish Financial Enterprise, and both of those institutions are looking at how to re-educate, how to create a really positive environment towards climate tech that is rejuvenating for different parts of the country, as well as seeking to meet the overall goals that we have for the country.
We pick one more question. So,
do you see the UK partnering with other financial centres to create a truly complementary and dynamic ecosystem for climate impact?
Yes, sure.
Yeah.
Yes, I do. If I could just elaborate on that one, in particular, if we look at some of the big challenges in this year of delivery, one area of particular focus is the voluntary carbon markets, and how we channel more capital towards the carbon projects which have genuine integrity. And there is a huge opportunity. We're already seeing the Integrity Council and the VCMI looking at how you genuinely collaborate on a global basis to come up with the right standards, both for supply and demand. And as we look forward to actually implementing those, I think there's a huge opportunity for London to be at the forefront of that and make sure that we are the landing strip for, the new core carbon principles, and for the new rules around transition. But also collaborating with others. Singapore comes to mind, the exchanges in the States. Why wouldn't we collaborate? This is a global challenge. That said, Theodora's question I thought was perfect, which is this point about local focus. If we are going to deliver the cash that Alok was calling on us all to do, turning those big commitments into movement of capital, it is going to be about channeling global capital to local solutions. And that's true in the UK, it's true in the emerging markets, it's true in the voluntary carbon market.
we've just got a couple of minutes left, so I think I'm just going to want one final round to come on to the question of, you pick up the point about the competition. It relates to what we were just talking about, and Richard saying that London or UK faces a lot of competition. Is London or the UK winning? How are we doing in this competition? So maybe come to you first, Joanna.
Yeah, I don't think in something like climate change, it's a global challenge, and we all sort of survive this together. So I think the different centres are actually much more collaborative than you might think, and they're learning from each other. I mean, the EU went first. The UK has the advantage to see which bits work better than others. But then when the UK implements, the EU will refine what it is doing. So I don't think it's one win and one loses. I think we all win together.
Richard.
I guess I'd look at this two ways. And many of the institutions that are represented here or made the pledges as part of GFANZ are global or multi-centre institutions. So in order for us to get our financial services institutions to contribute in the way we've spoken about today, they look at the world in a multi-centre way. So on the one hand, they want to see multi-centres of success. I would say there are certain aspects that the UK is probably behind on. I think perhaps green bonds and some aspects of green financial product innovation. I think there are other centres in Europe that might be ahead. And I think in different aspects that the other members of the panel have talked about, we could find other centres across the world leading on aspects of innovation or regulation or data. I think the real power that the UK has to bring is that it could be the leader in bringing the whole thing together. All parts of financial services, all aspects of how we make the transition that we've been talking about, and be the place that enables this integrated system to work. That, I think, the UK will win at.
Yeah, very briefly.
Very briefly, given that we are hosted today by The Economist, the importance of communication on this agenda going forward. If London or any other financial centre is to continue to make progress on this, we need to make sure this does not turn into a bipartisan discussion in the UK. We need to continue making sure that industry, finance, policymakers work collaboratively. Those of us in this room all have a duty to make sure there is no irresponsible communication or reporting on this topic, so that it does start turning into a new culture war that will not help anybody. There is no intellectually coherent pathway to prosperity that is high carbon. There wasn't before the pandemic, there wasn't before the invasion of Ukraine, and there certainly isn't now.
Well, I think in terms of energy and eloquence, what we've seen this morning is world-beating. So I think on that level, I leave very optimistic. Lots of really interesting thoughts. Thank you for getting us off to such a brilliant start. Thank you.